First off, my name is Vanessa Hall. I am the Education Chair of the North Carolina chapter of the Appraisal Institute, and I want to thank everyone for being here. Most importantly, I want to thank Terry Campbell and John Lindsay, John Lindsay, for being here today to discuss the self-storage real estate sector. And Terry Campbell is a small business lending head with Live Oak Bank. And John Lindsay is the co-founder and president of Lindsey Self Storage Group. So you're getting a real well-rounded discussion today. Did I get muted? I got muted. Okay. Must have muted myself. And, you know, there's no taking attendance or anything. So, you know, if you guys, I don't know if Terry or John, whichever one of you wants to start. And we do have some questions. We can do Q&A at the end. We have some questions already. So
cool. That'd be great. Yeah, I'm more than happy to kick us off. And Vanessa, thank you for hosting us. And if people do have questions during this, feel free to enter them in the chat window below, and we can hit them at the end for sure. As she had said, I'm John Lindsay, co-founder and president of Lindsey Self Storage Group. My family started in the storage business back in 1969. We have built, bought, and sold storage facilities all over the U.S. And then when we started Lindsey Self Storage Group in 2012, we help people buy and sell storage facilities in the U.S., Europe, and Asia. My family and I also own a chain of self-storage facilities. And actually, some of you might have heard on the beginning end of this call, Terry and I go way back. He started working with my dad in the late 90s. So he's actually watched me grow up over the years, and now we've done a couple deals together. So it's really come full circle. We've enjoyed working together and still live just a couple 30 minutes from each other now. And Terry, if you want to tell them a little bit about Live Oak, we can then dive into the market here.
Sure. Thanks, John. And yeah, John's is right. I get to see, him from afar sort of grow up over the years. And so I've known him a long time and known his dad even longer and worked with him back when I was actually with a building supplier. And a little bit about my background, and then I'll talk about Live Oak. Is I started in the industry as a self-storage building manufacturer and supplier in January of '95 is when I got actually into the industry. It was a great time. I didn't know what was what was to come, but man, looking back, it's great. I'm very thankful for that day that I started in that business. And in my 20 years, a little over 20 years with the building supplier, I really grew up in this industry. I was able to get into my first ownership in facilities. I've helped start the North Carolina Self Storage Association years ago, and I'm serving another term. Actually, I'm finishing up this year on the board for the association. And the associations are very important to our industry. So, if you are ownership, or when you're talking to folks who are ownership, encourage them to look into that, because it helps to make the industry healthy and sometimes helps you stay out of trouble. Live Oak Bank, a little bit about what I do now for the last 5.5 years, is specialized in lending to the self-storage industry. That's all my team does is lend to self-storage. When Live Oak started in 2008, we started as a lender specializing in veterinarians. Only lending to vets. They called us a doggy bank back then because we specialized in it. That's all we did. So when you specialize, you get really good at it. You get good at it. You're fast at it. You know what to look for. And that's the way Live Oak Bank has been built. And we've got 30 some industries we specialize. Plus we have a stable of actual generalists that lend in a lot of different things. But teams like the one that I'm the general manager of, all we do all day long, focus on self-storage day in and day out. And we also specialize in SBA lending. In fact, Live Oak is the largest SBA lender in the country by dollar volume. And we do more self-storage loans than anybody else in the industry. But in a nutshell, that's who we are at Live Oak and who I am.
Well, good, Terry. And, I think something that would probably give a good high level for everyone, maybe we can just kind of give a picture on both ends of what 2020 we've seen from the storage industry on through our experiences and what we've had. And I'm sure as everyone can relate through this Zoom, 2020 has been an interesting year to say the least. A lot of surprises, a lot of hiccups, a lot of headaches, and a lot of navigating some new markets, new industries, new practices. And something that we've seen on our side really heavily in the brokerage community, it's actually been a really high transactional volume year for us. We expected it to be fairly quiet given everything that was going on, a lot of market fluctuations, and changing tides, and we thought a lot of people were going to take some back seats as we saw their real estate classes dip, specifically in the commercial, retail, hospitality sectors. We've actually had a really busy year on the brokerage front. A lot of people have been dumping capital into storage. They felt very confident in it, as it has been an accelerator portion of their real estate portfolio. Again, as we've seen people, start to dip in their retail and hospitality, storage has stayed fairly strong. And so people have doubled down and continued to bet on the asset class. We've seen a small slew of buyers, fall by the wayside. They've had to cover losses in those other sectors that I mentioned. But on the whole, it's been an extremely busy year for us. We've been very happy at the trends we've seen. And thankfully, storage has been deemed essential business in most states. We've been helping people through these transitioning times, whether it's relocating for a job or having to house kids back from college, whatever those changing tides may be in their lives. Storage has been at the forefront of that, and we've been pretty happy with what we've been able to do through this year, not only for the communities, but what we've seen as the whole market trends. And then couple that with extremely low interest rates. It's just been a very aggressive buying season, and I think we're going to continue to see that trend. Uncertain times breed large demand for storage, whether we're in a booming economy and people have capital to spend and they want to redo their houses or buy a second home or send kids off to school, or in an uncertain down economy like right now where people are moving for new jobs or they have in-laws moving in or family moving in and they just need more room for space and stuff. There's always a demand for storage. And again, as we're seeing in this uncertain market, it's going to continue to breed this demand moving through not only the tail end of this year, but I think we can all agree into 2021, there's no imminent ending of our current state of the market. So I think we're going to continue to see a large demand in storage, a continuous demand for people to invest capital into the storage industry. We've got a lot of people moving to the Southeast on top of that, which creates another layer of demand in addition to that. So North Carolina, we've been pretty high transactional volume this year. And I think, Terry, you guys have seen the same on the lending side as well, correct?
Absolutely. We sure have. Sure have. And, piggyback a little on what John's saying, one of the things, another driver this industry has seen this year is, number one, I'm glad I'm not financing office buildings, okay? Because everybody's working from home now. And a lot of folks working from home, they've had to clean out that spare room or that extra bedroom to make an office now. Where are they going? They're putting in self-storage. Another one of the drivers, in addition to some of the ones that John was talking about, we have seen. Now I have, over the 20-some years I've been in this business, seen a lot of cycles in this industry and watched how it's been up and down. But overall, one of the overarching themes in self-storage is it's resistant to the downturns in the economy, because there's always, if it's good, again, as John was saying, when the things are good, times are good, people are spending money, they're buying toys, they're doing things, that creates a need. When things are bad, they're downsizing, or they're having, like some of these restaurants, they can only have half of their booths now. So some of them are taking them completely out and putting them in storage. There's just something always in whatever the cycle of the economy, there's something that feeds our industry. And it's been, other than a little blip back March and April, our industry still has done fantastic. We've seen it in our portfolio at the bank of our lenders. I've seen it myself anecdotally in the facilities that I'm a partner in. It's just been one of those things that everybody's wanting to get into, because people are seeing how this segment of the industry is such a great investment because of the recession resilience. Now, if the point in time comes where, nobody has a job anymore and nobody has income coming in because of COVID or whatever, eventually it's able to catch up with us. But, hopefully things never get to that point. We've seen a lot of, as far as the transactions this year, we've seen, still seeing a lot of new construction. I think new construction is down overall, but we're seeing more of it because a lot of lenders just aren't interested in new construction. But acquisitions are very active. There was just a huge amount of activity in Q3 with acquisitions. People are looking to buy. You had the CARES Act that provided 6 months of P&I payments for anyone who closed an SBA loan. before September 27th. You know, if you had an SBA loan or you got one and closed it and fully dispersed before September 27th of this year, you were going to have 6 months of P&I payments made for you by the SBA. So I know that a huge portion of what we saw then was driven by that, but there's still a lot of that activity out there. People are still looking to get in the business. People are trying to find those deals to buy because they feel safer with an investment like that. Even though the stock market's been doing great, it can turn around and drop tomorrow. I mean, it did yesterday. I think it did already this morning. Personally, for me, I'd rather have my money invested in a self-storage facility, something you have a little more control over. It's a little more solid, less volatile, but it's a great industry. And we're just seeing a lot of good activity. We, as a bank, or actually my team at the bank, we just exceeded our yearly production goal of new loans by 50%. Just because of all the activity that's going on out there and the amount of folks that are looking to get in the business. So.
Yeah, well, and Terry, I think you hit a big point there. Was people saw the resilience of this industry from the world financial crisis in 2008, and just to give you guys a quick little perspective on that, in 2008 to 2011, the self-storage REITs returned 111%. So while everyone else was flailing and collapsing, we saw this industry hold not only very strong, but do very well through it. And right now we're seeing this next wave of heavy betting on the industry. In the past week alone, I think 2 of the largest transactions I've seen in the past decade have happened. One of which is Blackstone bought the Simply Self Storage portfolio for $1.2 billion. And then Bill Gates invested in another buyout of a company that was valued at $2.7 billion. So the market itself, on a very institutional high level, is doubling down very heavily on storage. They're betting on it very heavily in the midst of COVID and the pandemic and everything that's happening with all these changing tides, which overall gives great comfort to us and the assurance that we have in our business and how we feel about it moving forward. And I think, again, as Terry said, with their volume they're having and the brokerage transaction volume that we're seeing, I don't think storage is going anywhere in the near future. And that being said, one of the biggest questions I always get is, well, what about disruptors? We're having a lot come up in other industries and classes with the advancements of technology and things like that. Personally, I haven't found one yet where you can replace people needing to put their stuff somewhere. There's no other tangible way to handle that volume of materialism we see in the United States. And as you see through the CGI trends over the past few years, people are not stopping buying anything. And as the millennial generation continues to consume and we make life decisions on a later trend, compared to prior generations, we're getting married later, buying houses later, and having kids on average 4 years later than prior generations. So as long as those continue to happen, we're going to see those trends continue to push this overall demand for storage. And again, through this uncertain year and uncertain times with, a never-ending end in sight, I think we're going to see a big push through storage through the end of 2020 and through the early 2020s as well.
John hit a couple of really good points there. Blackstone was already invested. They had part of their portfolio in self-storage previously, but when they really went for it like they did this time, that's a big statement for this industry. Bill Gates getting involved in this industry, that's another big statement. It's just showing that it keeps growing. We keep learning more ways, newer ways, better ways to operate and be profitable. For example, a lot of facilities are becoming unmanned using technology. And, that was something we were seeing some of over the last several years. COVID kind of sped it up somewhat to have that, contactless rentals. But like the facilities, sometimes that my partners and I buy, we buy facilities that maybe they may have a manager. We'll go in, clean things up, set it up, and remove the manager from the picture. And that all that cost and all that expense goes right to the bottom line, and thereby increasing the value of your facility by quite a bit. So there's something all the time, something new coming up, technology and different ways to be profitable. It's just such a very, very good business. Low overhead, low maintenance, great returns. Just you can't say enough good about it. I mean, I can't imagine being in any other industry. I imagine John feels the same way.
No, I mean, Terry nailed it. I look at a lot of different asset classes. Our clients come from all over the world and are invested in everything from tech startups to retail to hotel chains, you name it. And I keep coming back to storage time and time again. There's a great level of comfortability with the asset class. It's a very resilient class. Personally, everyone says that storage isn't sexy. I tend to disagree. It may not have our name on the side of a building in the middle of downtown, but the returns are great. It sustains well in the economies, whether good or bad. And I think there's going to be a demand for it for a long time to come. So we're very bullish on storage. We like the trends we're seeing. We like the direction it's going. Performance, even in a sketchy year that we're in right now, has been astounding. And if anyone has, any questions specifically at this point in time, we'd be more than happy to field them and walk you through it. Or Vanessa, if you have anything that you'd like us to touch on, we're more than happy to dive right in.
Sure. Well, let me pull up the questions I have, and then I'm sure people can, you guys can go ahead and unmute yourselves, or we can check the chat for any questions. So let's see here. Well, for John, a question that we have specifically for you, and I guess it's, Terry, you're welcome to answer as well, but what impacts to the transaction process are you experiencing because of the pandemic?
Yep. So great question. The best way to describe this year is slow. It has just been a drawn out process. I would say average, time to get a deal done. Historically, we're, 30-day due diligence, 30-day close, something around there. But with banks and getting, surveys and appraisals, everything done, it just takes a little bit longer. People are a little more held up, a little more constrained as to, what they're allowed to do, what they're get to. So I'd say average close window is closer to 90 to 120 days now. And the nice thing is everyone is understanding of that. Everyone is impacted by this and has been affected in one capacity or another. So for once, there's an understanding of some patience around the process that goes into this. And it's nice on both buyer and seller sides to recognize the importance of that and the steps we're taking to make sure that everyone is staying safe and healthy through getting this process done. But yes, it has just been a slow year in getting all those things checked off.
As far as the transaction speed he's talking about, sometime there for a while, it's not as bad now, but for example, the lenders need tax transcripts from borrowers. And there for a while, there was no one at the IRS at the federal government to even provide those for us. New construction deals, trying to close new construction deals. The offices where they provide permits or zoning were closed, and those things, as well as the items that John talked about, have caused delays in the transaction of facilities and loans.
Yeah, and and you're seeing that in a lot of different sectors as well. So let's see, Terry, I think I have a question specific here for you. From a lender's perspective, is there anything in an appraisal that you are looking at differently now during the pandemic relative to what you were looking at before?
In an appraisal, not necessarily. I mean, we just look at the end result and see, was there some exception taken, by the appraiser? And if so, what was it? If we feel like, hey, let's talk about this and see what it was. But nothing, we've not seen anything really in particular that we look for from the appraiser. It's just making sure they're taking everything into account using facts. That's it.
Okay. And then
not worry.
Yeah. And then Terry, so when the pandemic hit, most everyone pressed pause on new deals and new development. And is that getting back on track with regard to development, or is there still hesitation?
There is, it is still mostly back on track as far as, I think the confidence is back in the folks that are looking to build. The folks that are wanting to go out and develop a facility, confidence is pretty well back. Some lenders still have some confidence issues. Maybe they want more, cash in the deal, have a lower LTV. But as you know, for us, because it's all we do, we really understand the industry, we know how it works. As soon as we were allowed to get back in it, we jumped in and started working with these folks and just asking the right questions and making sure that there's nothing in that market that's been affected in a big way that's going to affect your facility. And one of the things about new construction is if it's new construction, you're not going to be open most likely for a year at least. Okay. Even during non-pandemic times, we don't know what's happening a year from now. We just have to go with what we know and what we have now. So we've been back to normal for quite some time ourselves, and I think most people are getting back to that and getting loosening the chains just a little bit on requirements and loan to value and things like that. But we're just very careful, as always, that we just make sure we have a really good feasibility study and that we're lending in a market that has a clear need and a strong study.
And Vanessa, on that note, I will say from the equity side, what we're seeing with a lot of our clients, as Terry said, they're taking extra precautions through due diligence now before building. But we have a number of clients that have built through the middle of this pandemic, have decided to do new projects through this. Again, the U.S. isn't slowing down. We're still growing. We have booming markets. Look at the Triangle, for instance, what's happening here in Charlotte, Wilmington. So, there's positive trends that are creating demand for storage. And again, a lot of people build these to hold for 5, 7, 10 years. We don't know what's going to happen in 6 months, let alone 5 years, but we work with the data that is available, as Terry pointed out. And so there has been a shift around, the markets and what we're seeing in rental rates and lease up and things like that. But people are still very bullish in putting product out and fulfilling that demand because overall, I think there will be, an eventual correction to a semi-normal pace in some due time, and we'll continue to see that lease up here, especially in North Carolina with the population trend we have.
Okay. And then, so we have a question in the chat here from Mike Elwell, and his question is, what impact are REITs and hedge funds having on valuations? And either one can answer. And then, is it still considered a mom and pop industry?
Great question. And I'm sure Terry will say similar things. He has a little more experience, a lot of these owners out there, especially getting new loans. I would say in the metro areas, it is a REIT dominated business. 70% of the industry is still the single owner operator, mom and pop. Getting into the top 50 MSAs, you are very heavily dominated by the 5 publicly traded REITs and some other large private operators. But across the United States, yes, very much so still a mom and pop business. The average owners that we're working with own 1, maybe 2 stores. And so there is still a lot of room for opportunity in the industry as far as acquiring and developing, putting together new opportunities. But I think it's becoming more competitive for sure. Again, getting traction from groups like Blackstone and Bill Gates and seeing that in the headlines everywhere. I've had more calls this year from private equity funds in Wall Street and Miami and Dubai and wherever looking to get into the US and invest heavily into storage than I ever have before. And these are groups that call and say, hey, we want to spend $100 million for the end of the year, $500 million for the end of the year. So they're very bullish in the industry. They like the United States. They like the market trends demand. So I compare it to where the hotel motel industry was in the 70s. It's very hard these days to find a motel that's owned by a single family. And I think over the next 20 to 30 years of storage, we will see that similar trend take place. I don't know how quickly it'll happen, but I think we are starting to trend in that general direction for sure.
Definitely, I agree with everything John has said, and yeah, it's still a mom and pop industry to quite a degree. But as he pointed out, being in those major MSAs, a lot of those major MSAs are getting crowded, and some of these big guys are moving into somewhat into some of the secondary markets. So that's making it a little more competitive as well. But overall, yeah, I agree with everything John just said.
Okay, and then Charles Alvarez also had a question. Are you seeing strains on rental rates of units between metro areas compared to more rural facilities?
Yes, I would say, as Terry just said, in a lot of those major markets, we're seeing some really hyper competition in those downtown MSAs. Let's take Raleigh's perfect example. I see higher rates in the surrounding markets, the Holly Springs, Apex, Cary's, Garners, than I do in downtown Raleigh. And that's because there's some oversaturation there. And again, it's not saying that it's not a good place to own storage or to build or this and that. It's just saying there's been a lot of competition introduced to a very small market in a very short period of time. So we're going to see a little bit longer of a lease up trend there. The longevity value is still there. But again, a little bit of oversupply, and we've seen the rental rates impacted as such. So, you might want to build a little further out. You overall may not get the value play you want in the long run, but you might lease up at an earlier pace with a higher rental rate on the front end than you would maybe competing in these downtown metros. And it's not just the Raleighs of the world and Charlotte's, it's Nashville, Dallas, Portland, every major MSA is seeing this trend of a little bit of oversaturation. And it's a very common trend in storage. It happens. There's this moving goalpost, and we get a lot of interest and a lot of capital flood to the market. And sometimes we get a little oversupply, but it will correct itself. As we've seen through COVID, we've seen buyers and builders fall by the wayside, and we will see those ebbs and flows through it. But overall, betting on a growing market like Raleigh or Nashville is not a bad play by any means. You just have to be comfortable with probably a longer than lease up period than you would have when you initially underwrote the deal 2 years ago.
Nothing to add there.
I think you go ahead.
I was going to say, I saw another question in here from Kelly. So are rising construction costs impacting financial feasibility in some urban markets? How are construction costs impacting timing overall in the property segment? Terry can definitely touch on this from his last one, but I would just say construction costs are higher now than we've ever seen them, especially steel prices. The cost to build a facility now versus a decade ago is insane. It has just become crazy, competitive, and expensive, and a very long waiting list for steel. I'm sure when Terry started Betco in the 90s, it was maybe 8 to 10 weeks to wait for steel. Now I've heard clients that are pushed out, 20 to 25 weeks waiting for steel to get delivered for a project. Mm-hmm. That's a totally different market than, where we were even 5 years ago.
Yeah. Yeah. The costs are definitely impacting the feasibility. This is something I keep an eye on daily, constantly, because we have loans in process that they're closed, but sites aren't ready. You can't really normally lock in the price of steel for very long. And typically you can't lock it in long enough to cover the time from the day you close your loan until you're ready to accept the steel. So you have to stay on top of that. You have to watch it. It is something I speak with the suppliers. I speak with the mills. I'm constantly trying to see what's going on, but they just had some increases, expecting some more increases coming. Part of this is a lot of it's actually COVID driven, because the suppliers have to put in orders with the mills, 6 months in advance. Okay, 6 months ago, everybody thought Q4 was just going to suck bad, Well, Q4 is awesome right now. So the orders they put in for Q4 back 6 months ago are tiny compared to what the actual need is. So there's a shortage. There's going to be a shortage. So time deliveries are going to be extended, like John said. And not only that, increases in price are going to be driven as well. So, and whenever, a steel mill shuts down, say a blast furnace is something that's necessary to make the steel. Well, you can't just say, oh my gosh, we made a miscalculation in our needs. You need to ramp up your capacity. That doesn't happen. A blast furnace can take up to a month to get up and running to a point where it's productive. So some of these things have sort of created a perfect storm. And then, you got folks out that can't go to work because of COVID or whatever. So it definitely has been an issue in making a project financially feasible.
And I think we have, let's see here. I did actually, someone private messaged me. So Reed Parks, I think you guys already touched on the second half of his question, talking about segregating your market analysis for larger markets versus smaller markets. But what about Class A properties versus Class C?
As far as in what light? What's
just with regard to you know, market demand? Are you seeing, what are the differences you're seeing in demand? And
Okay. Yeah. So from a buying perspective, we have a large swath of clients that some only want to build Class A, some only want to buy Class A, some only want to buy Class B and C value add play. I would say there's a larger demand for the Class B and C value add play in today's market. People are looking to get more creative in their value creation. You know, I'd say 5 years ago, a lot of big firms were just looking to place, you know, 100, 200 million and, you know, top 50 MSAs and clip a 5% coupon and be done with it. But it's become so hyper competitive in those markets, and we've seen a little oversupply and some overpricing. So people are now saying, hey, where can I go to create the most value for my product type? And they've realized that those surrounding markets, the Garners and Fuquays and Holly Springs of the world, catching all the same growth trends at half the price. So they say, well, why not go there, buy a mom and pop store and create some new value through an expansion or new management or new branding? And so we've seen a large push for that here in the past few years. And I think we're going to continue to see that for years to come as we see this hyper competitiveness, especially between the Reits and the top 50 MSAs, because at the end of the day, not only can I not pay the same price as Public Storage for a facility, they also spend millions a month in online advertising that I, as a single owner operator, could never compete with. So, it's where can we go to spend the same bang for buck to get an even better return?
Yep. Nothing to add from me.
Okay. And Christina wants to know, how has COVID impacted the lease up period in the Triangle area in particular? And what are you seeing right now?
Yeah, that's a great question. We had, I would say, the average facility saw a slight downtick in activity, especially in April. May, very par for course. And since then, tremendous lease up pace. And that's the same for accounts receivable. There's maybe a 4 to 8% uptick across all my clients' facilities, not only in North Carolina, but across the US through April, just because we didn't really know what was going on. Everyone was good. They're like, okay, maybe I'll only have to stay on for 2 weeks or 4 weeks. And that was fine. And I think once the world realized that, nope, this is going to be a longer term thing, go back to normal with the proper precautions, obviously, we saw the storage industry snap right back in line, because we're tied to so many essential businesses. And then on top of that, as Terry mentioned, people are working from home, they're redoing their office or their kitchen, and kids moving back in. There was just this constant influx of demand for storage through this entire COVID process. So I'd say normal, if not higher than normal, lease up pace since that point in time. But we definitely felt the initial impact in April and early May throughout North Carolina for sure.
Yeah, and it's not just North Carolina. It's pretty much the whole industry is like what John just described. It all just, like he said, snapped back and is done spectacularly for the most part.
All right. And then Kelly also had another question. Would you speak to the trends in facility design and what new features will be most prevalent in the future? How they're expected to impact marketability of units and the entire property?
Go ahead, Terry.
I was going to say, I think part of that depends on where it is. I think it depends on the market. But some of the trends that you're seeing now, multi-stories, smaller pieces of land, multi-story buildings. One of the partnerships I'm in, we built a 3-story building with a drive-through all the way through the bottom of the facility. People love that. It's in Florida, so people in Florida really love that, because you're able to drive in, you get out of especially in places like that where it's either really, really hot, the sun's beating down on you, or it rains 15 minutes later when you're not expecting rain. But you can drive in, unload, you're out of the heat, you're out of the rain, and then drive right on through and drive out. People love that. They love, people like the unmanned to quite a bit. I mean, the technology features that are coming out now, again, like I mentioned before, where you can save the cost and expense of a full-time employee or managers on the site. Things of that nature are kind of the trends, and they're not necessarily new, but they're becoming more prevalent. And I think the question there says, how will they impact the marketability of units? I think it's just going to increase it, and it's going to make the whole property more desirable and more valuable.
Yep.
And user friendly.
And as Terry correctly pointed out, we've seen a big trend in the competitiveness of facilities in these markets. Even 10 years ago, oversaturation wasn't really a problem, even in some of the top 50 MSAs. Now, because of the level of attention and competitiveness in a lot of these markets, people are looking for ways to provide better amenities, best product, best service. And so through that, we've seen this demand in people buying smaller lots, building vertically, or adding the automated platform, or rental through your smartphone, or whatever it may be. And so again, competitiveness has bred this great trend of quality in the storage industry. And overall, it's gained the marketability and attraction of Wall Street and more customers, and I'd say higher end customers, because back in the day, storage was just the steel building in the back of the gravel pit and in the industrial park. Well, now it's on Main and Main, and it looks like a hotel or an office building downtown. So I think storage has continued to grow and will continue to progress in a very high level trended fashion. And I think even in the past 5 years, the technology leaps have been huge. And as we continue to see that push forward, I think there'll be an even bigger demand for not only the product itself from a consumer standpoint, but from an acquisition standpoint from private equity.
John just mentioned something that's kind of cool. My camera's not working, but I can actually start my turn on a background I have. I want to show you a self-storage facility. This is in Marana, Arizona. Does that look like a self-storage facility? It looks like a hotel or a resort, for those of you who can see it. That's a great point. They're making them. There are Main and Main, and you got retail locations, and they look nice because the majority of the decision makers are women who make the decision to rent, even though they may not be the one always out there unloading the truck. They're making the decision, and they're going to rent from somewhere that looks nice because they want to rent somewhere that is safe. And when it looks nice like that and clean, that equates to safety, at least in their mind. So that curb appeal is going to translate into the feeling of safety, which is going to help drive rentals.
And I think a great point on this is one of my clients, this facility they built here, actually, they have this huge new system throughout the whole thing called the no-key system. And you can not only access the entire facility from your phone, you scan to get into your unit, scan to get in the door, you can rent a unit through your phone. And so we've seen this huge leap in technology that has finally matched the trend of where we are in the United States, because I think prior to past 5 years, storage was still a little archaic. And especially me as a millennial coming into it, I was like, why are we still talking about a Facebook page for your storage facility? And now we've got these great tech advances that have kind of brought us up to pace here. And again, being able to move into this facility without ever talking to a live person, access your unit 24/7, make all those advances has really started to set this great trend for the industry. And then think about now with COVID, people wanting to do contactless move-ins. Facilities like this are already poised for it. So some of them have put themselves in a great position heading into this time without even obviously knowing what was to come.
Mm-hmm. And John could, talking about the technology there, let's say John has a unit that he's rented there, and John's over in China or Japan or somewhere at a trade show, and he wants me to go get something out of his unit. He can send me a link to be able to access that code to use the Bluetooth to get into his unit from across the world. Little tiny things like that, are great. And this facility is like one of the very top, cutting edge facilities. And they did a super job with it. We financed this when they actually won the Facility of the Year 2 years ago. So that's why I have that picture, is we financed the Facility of the Year. Great project.
Yeah, I mean, it looks great, and not like, facilities of the past. And having used, storage facilities, safety definitely is key, because you are in there and the lights go on only when you move, and it's very quiet, and it's really, if you're there alone, it's kind of shocking. So it's, that's definitely a key aspect of that. I'm glad you mentioned that, Terry. Although I still, I think you do feel, safe in most of them, and that's something that's improved over the years as well. So another question we have from Mike McCaskill: are buyers currently underwriting any amount of rent loss in their pro formas due to the pandemic? Are they expecting any kind of discount from market value? And
so I think right now, we've seen such a low interest rate environment. People are still very bullish on their underwriting. They're trying to lock in debt right now while they can. Again, we've seen, I think, the bottom as far as what a slow moving environment is during COVID. April, when we had no idea what was happening. Most states were in full lockdown. The last thing people were going to go do is rent a storage unit, because we're like, oh, we'll just stay locked home for a couple of weeks and it'll be fine. We'll go back to normal. Clearly, that is not the case. So now that we have passed that and we understand this new norm that we live in, I would find it very surprising if there were to be another scenario other than a national lockdown, in which case we'd have much larger problems than renting my storage facility, but to where we'd get back to this slower move-in trend. So Mike, to answer your question, I have not seen it in any of my clients' underwriting as far as, creating that discount. Some have, created slower lease-up windows in anticipation of maybe just less people wanting to interact with others and their customers and consumers, but we haven't seen a specific discount. People have been like, I'm really concerned about COVID impacting my business. Here's another 10% discount layered in on top of that.
Okay. I think we have maybe, I had another question for Terry, but you guys already answered that. So let's see. So specific to the Carolinas, and you may have already kind of touched on this, what are you seeing overall in rental rates, occupancy, and capitalization rate trends?
Yeah, cap rates, I'd say, are probably the lowest we've ever traded, just because debt is so cheap. Interest rates are essentially nothing. We've seen deals trade in the low 4 caps. What is the new norm around a 6 cap now? Would have been a 8 or 9 cap back in 2010. So it's getting very hyper compressed with competition and a flood of capital and low interest rates into the market. Rental rate trends, again, we've seen decline in some hyper competitive markets, parts of Raleigh and Charlotte where there's been this oversupply. I think Nashville is a great example as well. And Tampa, overall, the market is going in a great direction and a great trend, and no one can deny that absurd growth we're seeing. But in the short term, there has been this oversupply that will hinder those rental rates for maybe a year or 18 months. But again, most people are building to hold on a 5, 7, 10-year window. So as long as it gets to where it needs to go by that time, there's a little concern for it. We've seen a lot of groups that have tried to pump and dump portfolios over the years. And Terry, you've probably seen it more than anyone. People come in and want to spend money in a year and sell it in 2. Well, then they're in trouble with pockets like that. But overall, still very bullish on those rates, those markets. It just takes some time to level back out.
Nothing to add. Thanks, John. You're saving me some talking time. I appreciate it.
I'm tired of being locked in my condo, Terry. It's my own talk today,
Have at it, buddy.
So how have municipal zoning and planning authorities influenced design and location trends?
Oh, quite a bit. Zoning has, because it's got to look a certain way. It's gotten to where, that's why you see that facility right there, is zoning wants to see things that blend in to the local themes of how they've got the area set up. An example of there's a project that we financed down in Fuquay that was finally able to get opened, that I've never seen anybody beaten up so bad by the zoning and permitting to get a facility to blend in and look a certain way and do things, just jump through all sorts of hoops to be able to build in a certain area. And the question about communities embracing multi-story designs, the more urban, yes, they're used to that. It depends on what you're used to. If you're used to living in an apartment building where you go in and hop in an elevator to go up, it's just another day, you know. But in some areas where there are no multi-story, sometimes it takes a little bit of training, so to speak, on and having to really sell those units for folks to get in the elevator and go upstairs. There's ways to do that, and there's ways to market it and sell those units, but they're being embraced in most parts. But you still have the folks who always just want to be able to drive up, throw their stuff in, roll the door up, throw their stuff in, and drive off. But if you need climate control, you're going to need to go inside, because there's very, very few climate control units that you access from the outside, because it's so expensive to build.
And we have a question from Safesh Singaram, and I hope I pronounced that right. How is the trend in North Carolina on conversion projects like warehouse conversion and container converted to storage units? And I know they're doing that with some old big box retail as well. So
yeah, so that's actually been a huge trend in the past couple of years. In North Carolina alone, I've had clients convert bowling alleys, movie theaters, big box, and I think now, especially through COVID, with the big gap in retail, that's going to continue to push that trend. I know, perfect example, when Sports Authority closed, I think it was 4 years ago now, I called them the morning they made their announcement, and I was the 15th person on the phone, and they said I was the 12th to call about self-storage conversion that morning. So people are taking advantage of these big retail spaces. They're perfect for storage conversion. You've got 40, 60, 80, 100,000 square feet in a perfect box. I mean, what more could you want to build a storage facility in an urban infill location? So that will definitely continue to be a trend. Again, it becomes very difficult with the cost to get in there. And so I think we're going to continue to see that push. But again, people are catching on to it. It's not a secret anymore. It used to be a kind of a hidden gem to get into certain markets, but it's becoming very competitive to get in there, and people are paying a lot to get into those. So we'll see how the trend continues, but it is a great fit for the industry at large. And
as a lender, I love a conversion because there's really almost no construction risk. Even though you're converting, there's some construction, but there's no construction risk. You don't have to worry about the weather. Let's say, and it can be done in the middle of the winter, where in some places you can't dig footings and you can't be out there building. You can convert a facility in the wintertime, and you're typically open much faster, doing business and bringing in payments so you can make your loan payments. That's why we like the conversions. But personally, I think they're fantastic too for the same reasons.
Yeah, that's a good point. I didn't think about it, but yeah, all the conversion is on the inside, so you don't have to worry about that.
And quite often conversions, you can, instead of getting a fight from the local authorities, sometimes you get help from them, because they don't like an empty building sitting there for lots of different reasons. But I've seen folks actually get tax incentives instead of being charged extra, and assistance in getting permits instead of having a fight for them, because there's an empty building there creating no revenue. It could be, it could turn into a crack house. There's all sorts of things that the reasons they don't want it to be sitting there empty.
And so I think, and you had already mentioned this, I think, John, at the beginning, about the Blackstone $1.2 billion acquisition of Simply Self Storage. Any, kind of comment or opinion on that at all, either of you? Do you?
Yeah, no, I mean, I think it's great for the industry. I love it. I've worked with Simply over the years. We've got another couple clients that have done work with Blackstone. I think anytime our sector gets that level of Wall Street attention from one of the largest wealth groups in the world is only a positive. And again, it's not like they just went in and bought out, 1,000 random mom and pops. They bought an already existing large portfolio, but it provides validity to the industry. It sets a bar for the year as far as pricing and trends we're seeing in certain markets. It's great for sellers because now we have a really high dollar per square foot sales price in a lot of stores in some, urban markets. So I think we're going to see a big trend pushed from that. And we've already had a lot of people call us, not only from the Bill Gates merger last week, but then with Simply on Monday. My phone was lighting up all day Monday and Tuesday with new private equity groups wanting to put capital in storage. So I think only positives. Again, the only downside I would see is if too many people got giddy on storage and tried to build in the same market. But that's where Terry comes in and tell them, no, that might not be the best idea.
Yeah, all those are great. Like he said, it gives tremendous credence to our industry. Lots and lots and lots of positives. If I could come up with a negative other than the one John just mentioned, it would be now, okay, there's going to be some attention drawn that we might not want. Taxing authorities, things like that could be a potential issue, but there's far many more positives to this than any negatives.
And so I guess, you know, I don't know if anyone has any questions they want to directly ask them. You can unmute yourself, you know, and I don't know if you have anything you guys want to close with, but I don't see any more questions here. And I think
Yeah. And Vanessa, I would just say, you know, first of all, thank you for having us more than anything. We love sharing about the industry. And if anyone has any questions on the brokerage development side, ownership, wants to know trends, not only in North Carolina, but throughout the US or abroad. Like I said, we do work all over the UK, Europe, and Asia as well. We're more than happy to speak on a macro trend level. But this being our backyard, I grew up in Durham my whole life. We know a lot about North Carolina and a lot about the storage trends here. And, you know, we've done a lot of work with Live Oak Bank as well over the years. So dozens of our clients. So they are the absolute best at what they do. And I highly recommend anyone reaching out to Terry as well for any needs they have in the lending space.
Yeah, and we'll be sure to share your email addresses with the attendees, just if that's, you know,
That's super. That's super. And thanks for that, John. And as he said, we both have a lot of industry expertise and experience. It's not just, we don't just talk the talk, we walk the walk too. So feel free to ask, call us, email us, whatever, you know, any questions you have at all about the industry, we'll be glad to help.
Yeah, well, thank you both, John and Terry. And I want to thank Mike McCaskill, who connected me to you both. He's my Collier's cohort in Raleigh. And so he helped set this up. I want to give him a little thanks. But I appreciate you both taking the time today, and such a great presentation, really great questions from everyone. So we'll definitely have you guys back for an update next year if you're open to that. So.
Hey, anytime you want, you give us a call.
Okay,
Absolutely.
Well, thank you guys. And everyone, with regard to North Carolina chapter members, we do have upcoming education on November 11th. We have advanced land valuations. And then on December 11th, we have desktop appraisals, bifurcated, and eval, a hybrid appraisal discussion. So we have those seminars coming up. Look for your emails, sign up, register for those. They're both virtual. And other than that, everyone have a great afternoon. Thanks again, guys. Have a great afternoon.
Thanks for having us. Thank you. Bye-bye.
Bye.